What is going on, guys, and welcome back to the channel. Now recently there have been quite a lot of changes in UK government, with 2 new Prime Ministers and 2 new cabinets. And following on from all these changes, there have been the announcements of a lot of new reforms that are going to be put in place that might affect you in a number of ways. But in this video, we're going to be looking at exactly how they're going to affect you as a stock market investor from a point of view of tax. And also look at a number of proactive ways that you can limit the effects once these changes are in place. But before we dive in, make sure to hit that subscribe button down below and click that bell so you never miss a video, because this channel is dedicated to helping you by making finance more manageable. Also, just as a quick disclaimer, this is in no way financial advice and I am not a financial advisor. What I will be doing is outlining information and giving my honest opinions and thoughts as a UK retail investor with over a decade's worth of experience. But with that out of the way, let's get into it. When it comes to being a UK stock market investor, there are 3 types of tax that you're faced with: stamp duty, dividend tax, and capital gains tax. But before we get looking at exactly how these are changing, it's really important to understand the income tax rates and tax bands, because depending on which tax band you fall under, these will have a knock-on effect on the amounts of these other taxes that you'll pay as an investor. So the first tax band we have is what's called your personal allowance. And within this first band, you actually pay no income tax whatsoever. Everyone is eligible for this on the first £12,570 that they earn each year. Then on any money that you earn over this amount, up to £50,270, you'll be charged 20% income tax on this money. And this is what's called the basic rate tax band. Then moving up from this, we have the higher rate tax band. So any money that you earn between £50,270 and £150,000, you'll be charged 40% income tax on this. And then finally, we have the additional rate tax band, which is any money that you earn over £150,000. And on this money, you'll be charged income tax at a rate of 45%. So with that out of the way, let's now get looking at the exact taxes that you pay as a stock market investor and how they're changing. First, we have dividend tax. So as you might expect, you pay dividend tax when you generate dividends from a stock market investment. Now the amount of dividend tax that you pay varies depending on what income tax band you fall under. For basic rate taxpayers earning under £50,270 per year, you'll be paying dividend tax at 8.75%. Then for higher rate taxpayers, you'll be paying 33.75% in dividend tax. And then finally, for additional rate taxpayers, you'll be paying 39.75%. Now these dividend tax rates aren't actually going to be changing at all. But what is going to be changing is what's called your dividend allowance. The dividend tax allowance is something that everyone is entitled to every single tax year. And what it does is it allows you to generate dividends without having to pay any tax on it. Over the last 5 years, this dividend tax allowance has remained the same at £2,000, but this is what's going to be changing. As of April 2023, this is when the first change is going to take place, at the start of the next tax year 2023 to 2024. And what's going to change is this dividend tax allowance is going to be cut in half to £1,000. This allowance is then going to be reduced further down to £500 per year in the tax year 2024 to 2025. As an example, just 2 years from now, once this second reduction has been put in place, if you had a £10,000 investment that generated more than 5% in dividends in a year, you'd have to pay dividend tax on anything over that 5%. It's also worth noting that this will be applicable to any stock market investment that you hold as a UK investor, even if it's in an overseas market, so for example a US tech stock. So that's the dividend tax changes covered. Now on to capital gains tax. Capital gains tax is the tax that you're required to pay when you sell a stock market investment for a profit. And again, the amount of capital gains tax that you'll pay will vary depending on what income tax band you fall into. For basic rate taxpayers, you'll pay capital gains tax at a rate of 10%, and for higher rate and additional rate taxpayers, you'll pay capital gains tax at a rate of 20%. These capital gains tax rates will be remaining the same, but again, just like with dividend tax, what's going to be changing is your capital gains tax allowance. The current capital gains tax allowance is £12,300 a year. So that means you can sell investments for a profit of up to this amount every single tax year, completely tax-free. But unfortunately, just like with dividend tax, this rate is getting reduced to £6,000 per year as of the tax year 2023 to 2024. And then move forward a year in the tax year 2024 to 2025, this rate is getting reduced further to £3,000 per year. In my view, this particular change is really going to be quite significant, especially for those who like to trade and buy and sell investments quite regularly. because you only pay capital gains tax when you actually sell an investment. So if you just simply buy and hold over a number of years, you'll only be exposed to capital gains tax when you finally come to sell it. So to put it into perspective, say you had a £30,000 investment that you sold for a profit of more than 10% in that tax year. You'd have to pay capital gains tax on anything over that 10%. So to me, this change is going to be very significant, as it's going to bring more and more people into that bubble of having to pay capital gains tax on their investments. And again, it's important to know that this is relevant for any stock market investments you have, even if they're overseas. Now finally, the third type of tax that you need to be aware of as a stock market investor is stamp duty. Unfortunately, this isn't going to be changing whatsoever. But just as a reminder, stamp duty is a type of tax that you have to pay when buying certain stock market investments. And you'll be charged stamp duty at a rate of 0.5% of the total investment value. However, it is only applicable to certain investments, so individual UK stocks and investment trusts. Other investment opportunities like ETFs, funds, open-ended investment companies, unit trusts, and foreign investments won't actually require you to pay any stamp duty at all. So with all of that in mind, you might now be thinking, what should I do as an investor to try and prepare for these changes? In my opinion, the first thing to do is start moving money into an investment ISA, rather than a basic investment account. The benefit of an investment ISA is that it shields you from ever having to pay capital gains or dividend tax. The only thing you will still have to pay though is stamp duty. The only downside of an ISA is that you can only deposit £20,000 each tax year into any of the ISAs that you have. So if you have an investment ISA and a lifetime ISA, as well as a cash saving ISA, you can only deposit £20,000 across these. And also, if you have an investment portfolio of more than £20,000 sat in a standard investment account, you'll only be able to move £20,000 of that money into an investment ISA, assuming that you've not utilised your ISA allowance already. If you've already maxed out your ISA allowance for this year, the other thing that you can do is utilise your capital gains tax allowance. So let's say, for example, you're a long-term investor who started investing 5 years ago with £10,000. This money's all sat within a standard investment account, not an ISA, and you've already utilised your ISA allowance for this year. Imagine that £10,000 has doubled in value up to £20,000, but you've never actually sold the investment. You've just simply bought and held. If you still want to hold that investment for the long term, what you should do is literally sell that entire investment and buy it straight back. Because what this will do is it will utilise your capital gains tax allowance now of £12,000, whereas once the next tax year starts, you would have to pay capital gains tax on £4,000 of that £10,000 profit. So it's better to do it now and simply just buy back the investment to basically reset your investment gains. The only thing to bear in mind is that you'll probably have to pay some fees or stamp duty, but this is something you'll have to weigh up for yourself to see if it's beneficial to do so, as every platform is different and will charge different fees. Now, just one final thought to leave you with. Some of you might be thinking, well, my investment portfolio at this point is just simply too small, and these taxes aren't ever going to affect you because of the size of your investment portfolio. But what I would say is that it's still really important to start acting now and try to move as much money as you can into an ISA. Because if you're thinking long term about building wealth and trying to achieve financial freedom, this really is the place to start. And you'll be surprised with how quickly your investment portfolio has the potential to grow thanks to compound interest and a bit of discipline. And once you get to this point, do you really want to have to start paying unnecessary taxes that you didn't need to pay if you just moved money earlier into an ISA? I know what I'd rather do, but let me know your thoughts down below in the comments and feel free to challenge me on anything that I'm saying. But with that being said, if you did make it this far, thank you so much for watching, and I really hope you guys found it useful in some way. This channel is dedicated to making finance more manageable, so make sure to hit that subscribe button down below and click that bell so you never miss a video. But on that note, keep saving and have a great rest of your day.